Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Welcome to the new week, 16th to 20th of January. We are on 16th of January now. Between 5 and 5:30 GMT, I'll try to explain to you what is expected from that of the Forex market following my forecast algorithm. Besides, we'll also do the market reading for today and find out how exactly the players intend to make the moves in the market. And also, I'll explain to you about the trading strategy, how essential it is in order to limit the risk and maximize the profit. So the three components, namely the derived forecast, market reading, and trading strategy, are to be used depending upon this time frame. And also we need to follow the market timings specifically. Now this is why GMT, that mid-Japanese session. So we have to follow the timings followed by that of the players and then understand how exactly the market is being manipulated. The session-wise times are given here and also the type of moves expected during this particular week. And it is a trend reversal month. During the month of December and January, the players do the yearly trend reversal. So whips and moves are part of the game. Extended stop and they do it very frequently. And today we can see a visible extended stop and they have done it in the case of GBB, dropping about 150 pips net change level from that of Friday close and stopped cutting the new low and started gaining slowly the levels. So this is how they try to make the moves for that of the trend reversal time. Besides, they also come across the contrarian moves very frequently in order to handle the crosses, and also they come to the majors from time to time. And so they are trying to position themselves by accumulating huge positions at the lowest level for the season in all the majors and also in the case of the crosses. And that is why they make such moves. And this is not uncertainty. This is not something depending upon the economic conditions, etc. Every year beginning, they make such moves. If you watch it carefully, then you will be able to understand the players position themselves during the early part of the year, and later on they gain the levels quickly and they exit around the month of September, October, and then start making the slide to drop the market and induce the traders to get trapped and again start accumulating the positions during the month of January. So this is the yearly phenomenon. So we need to understand the yearly type of moves the players do it so that we'll be able to split it into that of the monthly moves, weekly moves, and the daily moves. Then we'll be able to understand how the players have got a broader picture developed beforehand, and they follow that systematically and try to earn money from that other market. But we use a different language to read the market in the name of technicals and fundamentals, and then we get confused and we always wait for the uncertainty to grow. And once the uncertainty reaches the peak, that is the time of release of the data, etc., then we really become highly perturbed and become emotional, and later on see that that is a wasteful exercise. Becoming emotional is of no use, and simply envisaging something and when it does not happen, becoming upset, they are all not part of the trading process. They are all nothing but the emotional process, and they are detrimental to that of trading. So we have to understand that trading requires the appropriate trading decisions and when to enter, when to exit, and also the time frame to be followed. So hence I give the forecast for the entire week following the time frame. 00730 to 7:30 GMT is the Japanese session, And the European session starts by 8 GMT up to that of the 14 GMT. Then 14:30 to 21:30 GMT is the US session. So you can call it as 3 different sessions because these are all the timings followed by the other players. So we need to understand on each day how exactly they are going to make the moves. So this forecast is based on the envisaged condition of the players' market moves. So if you watch carefully every session, they will be making the move in line with that of the expectations. That is what I have been doing, giving the forecast on Monday and trying to review the forecast on Friday and show you how exactly they are making the move in line with that of the expectations. And this is mainly to give you the confidence that the players are being driven by some extraneous force, and because of that they are making such moves, and for them certain events happen as natural events, and such events induce them to go in for such market moves. So it is a phenomenal move which is happening in the galaxy, and then such factors influence the players as well as the traders. So you come across there is a tug between the players and the traders. That players cannot earn even 1 cent unless and otherwise they trap the traders. So that is why you come across every time they pretend as if the market is following technicals and fundamentals. And once the traders think that the going is good and let us commit the positions, they suddenly reverse the market from the midweek and start making the move against that of the expectations of the traders. And then I always say that they create the market sentiment and act against that of the traders. So keep that in mind, and nothing is permanent in the market. The market sentiment is short-lived, but the traders mindset is also short-lived, and they don't remember or keep the sentiments forever. But only thing is there is a lagging with regard to the keeping of the sentiments among that of the traders when compared to that of the change of the sentiment the market is bringing in from time to time. So this time gap invariably is making the traders to lose money in the market, because after the event the traders repent and realize, yes, I should not have done that. But before committing such mistakes they don't realize it. So every time you find that the traders are forced to commit mistakes, and normally a saying is a wise man does not repeat the mistakes, but invariably you come across in the market the traders are induced to commit the mistakes again and again, again and again, and lose their account, lose the trades, etc. So we have to invariably understand how we become the victim of the circumstances and how exactly we have to get rid of it, rather than trying to blame the circumstances or trying to elevate it and say that market is crazy, etc. Instead, we should try to find a methodology by which we will avoid getting trapped with the market sentiments. Now, the derived forecast for this week. Today, 16th of January, swing and slide is expected during the Japanese session. Already they have made the slide, and then you find the swing and firm up. And again during the US session, they will make the swing and slide and create the feel in the market that US dollar is going to be the king. Then from tomorrow, they are expected to slowly gain the level, create the uncertainty by making the slide during the European session and start making the firm up move. And then Wednesday, they will make a dip and then rise, and then continue to rise during the US session. And on Thursday, 19th January, they are expected to rise and then make some profit booking towards the close or towards the of the US session. Then later on, make a slide to induce the long holders to liquidate the long positions before making a rise during the European and the US sessions on Friday, 20th of January. So You may come across that it might coincide with so many other events, etc. But they are all not the real influencing factors. They are all nothing but the excuses. But ultimately, the market is determined to make moves in line with the expectations of the forecast. And it is not that I'm trying to say that my forecast is great or something like that. It is mainly similar to that of the calendar what we follow. And today we are on 16th, and we are definitely certain that tomorrow is 17th January. You know how certain we are. In a similar way, the forecast also gives the market expectations of the next day and the day after, etc. And I am able to give the forecast for n number of years using this particular algorithm. But for the benefit of small traders, because I do not want to give the long-term forecast, and then keeping that long-term forecast in mind, they start holding the loss-making positions. Without considering the intraday volatility, and when the equity erodes, then they lose money. I do not want to influence them to hold the loss-making positions for a long time, even though the market is expected to recover big, etc. Hence, I give only the forecast for the entire week and still recommend during the trend reversal time only to do the session-wise trade. That is, take the position during the early part of the session and close it by end of the session. Or you do the intraday trade, like take the position during the first session and close it by the second session. That way, if we try to do it, you'll be able to make small swing trades and build your equity. Building the equity is the utmost important thing for a trader, rather than looking for various market sentiment and looking for what is going to happen to of the currencies when the new president comes in, etc. And when we can envisage such things, but ultimately what is important is whatever the position you take, we should be able to see profit in it. So invariably, you find that there are various attributes for the market to go up or come down, and we spend most of the time in analyzing the various attributes and fail to analyze our own trade. Because of that, we find that the uncertainty linger in our mind again and again before that of every data release time. As a result, what happens that we develop the market fear. And after developing market fear, losing a few trades, we always say that wait for the market to settle and then try to take positions. And when you try to wait for the market to settle and try to take position, you can earn 10, 15 pips or 20 pips profit in such trades when the market is calm. But actually, during that of the data release time, you find the market is showing real volatile moves, and hence I've been giving the spike trade calls during that of the data release time, so that we'll be able to really capture a big profit and be an opportunity trader. Wait for such events to happen and trade only during that time, rather than trying to commit a position and wait for the market to move. And when the market is not moving, you lose your patience and cut the position. So avoid such things and be a smart trader and be an opportunity trader. Let me show you the levels in which the currencies are expected to swing during this particular week. Euro could come down to 1.0550 area and then gain to 1.09. Last week I shown on Friday the levels, how exactly the players have just made the moves in line with the expectations of the range. They are all mathematically derived levels because the players have got certain limitations. Beyond that, they will not be able to do anything. So based on that mathematical information, I am trying to give the levels, and which will be invariably following the focus, so that you will be able to really understand The levels, the timing, and also the forecast we can make use and try to earn. So for that, I'm not expecting any reward from you, and I want only you to earn money from that other market in a safe way and try to build your equity. And once you have built up enough equity or recovered the last money, you quit the market, because the market is known to trap the traders again and again. And you might become a successful trader, and then suddenly you will find that after earning so much of money, you lose it again. So it is a vicious cycle. So avoid being here, but try to earn back the last money following this, and then try to just watch the market for fun and be an opportunity trader. Wait for the market to make very quick moves and try to do some trades and earn. And that way, you will not become addicted to trading. Now, in the case of GBP, they just made a phenomenal drop as an extended downward stop, and to recover all the last levels within the day or the day after, and then they will continue to gain the levels in a very big way. Normally, during that of the trend reversal time, they make such extended stop, and either in the case of GBP or in the case of USD and so this time on the downward stop, and when all other currencies are showing a nominal net change from the Friday close, GBP has made a big downward stop, and they said that it is because of the British exit, etc. By end of the week, we are going to review on Friday how exactly they just simply used the British exit from the European Union and currency understanding, and then later on how they made a big rise in the case of GBP, simply discounting all the information what they have been highlighting on Monday. Then in the case of yen, they could come down to 113.50 area and then start gaining it to 117 area. In the case of USD CHF, they could come down to parity or slightly go below that during this week, and then you could come across the highest 1.02 area. Then in the case of Canadian dollar, they are expected to come down to 1.3050 or slightly lower, and probably they could breach 1.300 during the intraday also if needed, and then go to 1.33 area. The case of Australian dollar, they just slowly and consistently gained the levels to 75 area, and they are expected to come down a little bit to 74, 75, and then start gaining to 77 area. So in all, you will come across the USD weakening move in the case of Euro, GBP, as well as Australian dollar, and USD weakening and the gaining move in the case of the denominator currencies like the USD and USD CHF and Canadian dollar. They are expected to make such USD weakening move, USD gaining move, and the contrarian move. So understand when they are doing the contrarian move and trade in the case of process accordingly. Now, if you see that Euro, USDN and the GBP, they are showing negative net change as a contrarian move on the downside, because Euro and GBP are showing the USD gaining move by making a negative net change from that of Friday close. But USDN is showing negative net change from that of Friday close, indicating the USD weakening move. So when USD gaining move and USD weakening moves are shown by different currencies during the same time frame, it is referred as a mixed move or the contrarian move. Then you find in the case of USD CAD and Australian dollar, they are showing the USD gaining move. So you find the mixed move and the USD gaining move alternatively, and today they are expected to make the week beginning false move. Then understand that we'll be able to capture some positions during the quick drops, and then subsequently when they gain the level, we will be able to book profit. Now, after doing the forecast part of it, I'm going to do the market reading for you to find out whether the market is moving in line with that of the forecast from time to time. So I note down the initial lows and the highs in the case of euro and in the case of 4 majors and 2 commodity pairs. Euro formed the initial low 1.0610, and they just breached and came down to 1.0605 and come above that 1.0610, indicating they made a brief downward stop and in order to make a firm up move and then make an upward stop and then start making the slide. So either way swings they make in order to widen the range, and you can do the range trades or do small swing trades during a downward stop and take a buy and book profit during the upward stop, or take sell during the upward stop and book profit during the downward stop. In the case of GBP, they are not done the downward stop because the initial low what they have set is they are retaining and they started gaining the level, and 1.2055 is the initial high which has not been breached. They are holding at the middle level just to create that feel to the traders that GBP cannot recover, and that is how they just induce the traders to develop the market sentiment. And in the case of USD, 113.98 is the low, 114.47 is the high. They are not breached the low or the high. Then CHF, 1.0091 is the low, 1.0112 is the high. They just breached the high and went up to 1.0115, started coming down below that of 1.0112. When they made the downward stop, and in the case of Euro, they made a brief upward stop, and in the case of CHF started coming down, and they are likely to come down more in the case of USD CHF in this week to one parity and slightly below parity. Then Canadian dollar, 1.3119 is the low, 1.3146 is the high. They are not breached the low or the high. When the spread is less than 40 pips in all these currencies, then avoid committing positions because it will take a long time for you to book profit, and then you will be holding the position for a longer time. That might test your patience. Once the spread becomes more than 40 pips, you commit position looking into the time frame during the early part of the European session or late part of the European, US, Japanese session. You try to commit a position when they are making the spread more than 40 pips, and when they are making a downward stop and take a buy, upward stop and take a sell, we'll be able to easily book profit. And in the case of Australian dollar, 74.80 was the initial low, and they just breached, came down to 74.69 and holding below that of 74.80, indicating that they are making a brief extended downward move before making an intentional upward move. The high is 0.7506, which is not breached. So in all, you find Euro, CHF, and Australian dollar, they just made the breaching of the initial low or the high, and the other currencies, they are holding it in a range. Slowly during the day, they will try to widen the spread. Now coming to the trade calls. So when they are making a downward stop, and I was recommending a buy in order to book profit. When they are making an upward stop and a quick rise, keep the hedge order to limit the risk. And in the case of this GBP, during the late session, they could come down quickly closer to the low and then start gaining the level. So you can take a buy at that time and then keep the hedge order to limit the risk. Once the position makes profit, keep stop at entry. And when they quickly make a rise, you use the trailing stop in a profit making position and capture the profit. Then in the case of yen, again, they are expected to make a brief downward stop and before making a rise. So at that time, you can take a buy and book profit during the upward stop. And these trades, you can try it in a demo trading platform in order to find the success of the trades consistently. Then you can follow it in your real trading account. These are all the subdivisions of the time frame, what the players are following. So Japanese, European, and the US sessions, and the session timings are given here. And each session time is further divided into early, mid, and the late session. Besides, you come across the gap time between the sessions. And what they do during the early and the late sessions, they handle the majors. During that of the mid session, they handle the crosses. So if you take position during that of the early session near the low a buy or near the high a sell, or during that upward stop and a sell, during a downward stop and take a buy, then close it by late session, you will be able to capture easily about 30-45 pips profit in your trades. And commit positions wherever the spread is more than 40 pips, so that your profit margin will be also 30 to 45 pips. Otherwise, it may end up in booking about 10-15 pips profit. Then similarly, European also, the early and the late session. Then the US also, early and the late session. The session timings are given. Follow those timings, then you will be able to really understand that you can simply take the position during the early part or this early part and calmly hold the position during the mid part and book profit during the early part. And invariably, you'll find when they make a downward stop and they will close the market at a higher level. When they make an upward stop and during the early session, they will close the market closer to the low. Then that will give you more certainty in trading. Let me answer to the questions. Still, I have the original buy of the 117.85. No. Unless otherwise your equity permits for you to hold for such a long time position, it is not advisable to hold loss making levels. They hit sell and the original upper levels. Any help recommending a remedy for this? See, as far as yen is concerned, I explained many times that the denominator currency, they make the one-sided moves, especially in the case of USD yen, because by making continuous drop in the case of USD yen, they are able to bring in continuous drop for about 1,000 to 2,000 pips in the case of yen crosses, which is predominantly traded by that of the traders. Many of the traders, they take the position in yen and yen crosses, thinking that they will be able to quickly make profit, and they follow the technicals and then try to find the trend is our friend and commit positions. But the players make wide stop-ins and then start continuously making one-sided move, and invariably such information will give that impression to the technical analyst that there is no going to be any trend reversal, and invariably traders or the analyst think of the breakout trade, and that is ended up in holding a buy position around 117 area, and you have to wait for the market to go up this week and the next week, and it will be time testing. Instead, you have to use the trading strategy effectively rather than consistently booking profit on the sell side. And once such position is hedged, if you keep stop at entry and wait for the market to close it and then continue with that of the buy position, you would have earned nicely. Otherwise, if the hedge, the stop at entry in the sell side is not being filled for 2 days, you can understand the market is on the downtrend. Close the buy position with 100-150 pips loss, but still that sell position will be making about 70 to 80 pips profit. And once the market comes down little more, strategy instead of holding simply the positions and pray to God that I should somehow make money from the such positions. And regarding the remedy part of it, I can only suggest wait for the market to make an upward trend, and then only you will be able to close the 117.83 buy. Any other question, please? Then as far as the Asian early session, how would you know which pair to take position in, since all spreads are being widened? And does the early session predict the direction of the late session? Like the example, you decide to buy early and then would like to take session being sell. Okay. See, as far as the early and the late sessions are concerned, taking positions and closing positions, I told you the precondition is that the spread between the high and the low should be more than 40 pips. Only in such currencies you commit positions. Now you find that in the case of USDN, they made more than 40 pips spread. So when USDN was near that of the high around 130 GMT, you could have taken a sell, and then you will see that it is making a downward move, you can book profit. But in the case of GBP also, it was making a downward stop at that time, and you could have taken a buy, and that will be making profit during the rise. You can keep stop at entry and book it. And if you want a decisive trade to happen, then wait till the early European session. The spread will be more than 40 pips in all. Then also you can study the contrarian move is happening, or the real US dollar weakening or the US dollar gaining move is happening. Only when you come across the US dollar weakening or the gaining move in the net change, you take buy position near that of the low or sell position near that of the high in the majors, you will be able to make 100% profit without any ambiguity when they are continuously making US dollar weakening or US dollar gaining move. Now we come across the contrarian move is happening. That is, Euro and GBP are showing the US dollar gaining move, USDN is showing US dollar weakening move. At that time, if you try to take position, you have to be very careful in keeping the hedge order to limit the risk. And once the position makes profit, keep stop at entry and remove the hedge order. And you have to systematically do that. Only then we will be able to earn money from the market when they are making contrarian move. What is that risk thing involved? See, when USDN is making a downward move and Euro and GBP are showing the downward move, you find that Euro Yen and GBP Yen are on the lowest level. And afterwards, you expect them to go up. But what happens is they may simply rise USDN and drop Euro and GBP as a US dollar gaining move. And in such a situation, you'll find your yen crosses will come down more. So yen crosses can come down because of yen downward move as well as the downward move of Euro and GBP. So you need to understand that and then try to commit positions in the case of crosses whenever they are making a contrarian move. When they are making clear-cut US dollar gaining or the US dollar weakening move, if you commit positions in the majors, you will make 100% profit in line with the trend what they are doing. Then in the early session, does the intentional move slower than the extended move within the first 30 minutes? Or would we wait for 2 hours for them to see the difference? No, as far as, see, your question is to find out whether it is a stop and or an extended move. Stop and happens in less than 30 minutes and the extended move happens for 2 hours. So to start with, during the day, they will try to only make a stop and in order to widen the range between the high and the low. And later on only they will make the extended move or the intentional move. And you know that extended move, suppose they just make a downward stop and in the case of Euro and stop cutting the new low for 10 minutes to 30 minutes and then gain the level above that of the initial low, you know that it is only a stop and to close during the late session above that of the high. Then you can take a buy during a small dip around that of the initial high, low 1.0610. And then book profit around 0.6440 level when they are making an upward stop. You have to decide on those trades carefully. And whenever they are making an extended move, then we know that they make a quick downward stop, and extended move also they make a quick downward stop, and afterwards they come above and hold below that of the initial low for more than 30 minutes in the case of Australian dollar. And but they stopped cutting the new low, and they are not going above that of the initial low. Then they wanted to wait for 2 hours as an extended move and then start gaining the level. So don't be in a hurry to come into position. They will make a false move up to that of the low before making a rise. And that you can watch and try to take a buy position. So focus on the type of moves they are making it. Then you'll be able to really understand their intentions without any ambiguity. Is there any question? Okay, then let me show the forecast slide again. Benefit of later. So the expected market moves for this week is being displayed here, and they are expected to make a downward move today and then slowly start gaining it. And then after gaining considerable level, they could just pretend as if the market is going to drop on Thursday and then start gaining the levels on Friday. That's what they are expected to do during this particular week. The range in which the currencies are expected to swing is also shown here. You can just take the buy positions during the downward stop, and they are likely to gain the levels. Use the trading strategy of using the hedge order in a loss making position and trailing stop in a profit making position, so that you will not be surprised when the market suddenly reverses as an intraday trend reversal or the weekly trend reversal. You will be able to protect your profit. Ultimately, earning money from the market is more vital rather than simply giving the prediction about the market. These are all the initial lows and the highs. They are used in order to find out what sort of moves their players are trying to do it in the market from time to time. Then the recommended trades for that day are given here. Whenever they make a quick downward stop during the late sessions, you try to take a buy, book profit during the quick rise, and initially keep the hedge order to limit the risk. And once the position makes profit, keep stop at entry and book profit using a trailing stop in a profit making position, and keep a trailing take profit order. That way, we'll be able to really dynamically book profit. So there are no more questions. So I'll wind up the webinar. Let me take this opportunity to thank FX Street for the facilities provided to present the webinar. I'll come back on Friday and try to review the forecast, what I have given it, and try to find out how exactly the market is moving in line with the forecast in order to give you more confidence in our trades, so that get rid of the uncertainties and the market fear will diminish. That will help you to earn money from that other market. Always aim for swing trades and hold the position only with the stop at entry and not simply the loss making positions. And that is not the real way of trading. And the real way of trading is maximizing the profit using a trailing stop in a profit making position. Wish you all happy trading. See you all.